we're still at the Fmdq's Nigeria Debt Capital Market workshop at the Eco Hotel and Towers, and I'm just joined. He just stepped down from one of the panels, and we're going to be talking to him about the relationship between the debt or the bond market as it is, the capital market as it is, and mortgages. I'm with Hakeem Ogunniran. He's the MD of UPDC. Welcome to the welcome for joining us on the platform.
Thank you very much. I'm glad to be here.
Yes, the first thought I would like to, one of the major issues we've realized with Nigerian mortgage, the mortgage industry is that it's not as robust as we would have loved it to be. Very similar to basically around areas of liquidity. There's still the talk of a huge housing deficit, across the Nigerian board. Do you think that the capital market is a viable means to solving that liquidity problem that the mortgage industry needs?
You know that if you're talking about an effective mortgage system,
yes,
you have to start from creating the assets, because I always like to stress that before you originate mortgages, you have to create assets.
Yeah.
And before you create assets, you need finance. You need finance at the construction end, and you also need retail finance.
True.
And the capital market happens to be a very strong vehicle to generate the kind of finance that you need. Because real estate, if you're not careful, you can have a mismatch of your assets and your liabilities. Because real estate is typically a medium to long-term business. So you need a financing model that allows you to match your assets and your liabilities. What we have done, for example, we floated a bond. We floated a 5-year bond in 2010, which we have just finished repaid. And in 2012, we also floated a REIT, because a REIT allows you to create, to pool resources, capital from a lot of people in the market, and then it is quasi-equity, which you hold for a long time in your company, and it enables you to do what you do. So I think that if properly structured, the capital market can actually serve as a very strong platform for generating the kind of capital that you need in the real estate industry.
There's also been talk of, the mortgages being refinanced. Recently, the NMRC
Yes.
did refinance one of such bonds, and it seemed like a landmark for the mortgage industry as a whole. How that as a start,
Yes.
where do you think that is going to take us in the, say, maybe 5 years?
Okay. The first thing we must understand is that part of the problems in the market today is the fact that, number one, mortgages are in short supply because the tenors are too short,
Yeah.
interest rates are too high. But even for the few mortgages which the primary mortgage banks and other commercial banks have created, they have not been able to on-lend those mortgages to another institution. And that is why the NMRC comes in. NMRC is a refinancing institution. So what NMRC does is to create mortgages already originated by the primary mortgage banks, and NMRC buys off those mortgages and provides further liquidity for the mortgage banks to be able to create additional mortgages. So I think that if we get the sequencing right, if we allow it to work seamlessly as it is anticipated, that will help to boost this segment, because then you have somebody originating the mortgages, somebody buying off the mortgages, and you can create further liquidity in the sector. And I think that will work well in the long run.
Well, removing all hindrances as a whole, imagining that there's nothing that can stop us, what do you think would be the key thing that would drive growth in the mortgage industry?
Okay. Unfortunately, the world of mortgages is not as simple as removing all hindrances. There are fundamental obstacles. Some of them we have mentioned on the panel, because ultimately it is about creating assets. And creating assets is about building houses which are affordable. So you have to deal with the issue of title. You have to deal with the issue of infrastructure, because as a developer, if you have to buy land in the open markets, you have to provide primary and secondary infrastructure. The exit price of those houses are going to be very, very high. And they may, in a lot of cases, not be readily affordable to those who need it. So we have to deal with all those issues around title, around infrastructure, around cost of financing. You know, if you look at the structure of the economy itself, when you have MPR around 12, 13, everything is priced off the back of MPR.
True.
You know, so the cost of fund for even developers is in the region of 18, 20%. You know, by the time you add that cost, and then you discover that the cost of the house are unaffordable, you know. But in case something happens, like you said, and all those hindrances can be removed, then we start to have a mortgage party all over the country. Because then it becomes easy, you know, for anybody. You already have an affordable house, and you're a salary earner, you can raise your initial equity, you can take a mortgage for the appropriate tenor, and then life will be as it ought to be.
Thank you very much, sir.
My pleasure.
Appreciate you for being with us.
Thank you.
That was Mr. Hakeem Ogunniran. He's the MD of UPDC, and we'll be continuing the discourse. Remember, you can follow us. Just check for more videos. Do stay with us.